Hi, Larry Gaines, PowerCycleTrading.com. I did a video last night. I went over my free video of how to spot or identify a market top and the option strategies that I like to use. So in last night's video, you might want to go back and review that. I went through what we look for, to identify a top using the different tools that I've used to identify when markets are kind of stretched or overextended and overbought. And then I went through the option strategy, one of the strategies that we like to use, which was the calendar diagonal spread. So I went through that one last night. And then for this video, I'm going to go through the other strategy that I like to use that I mentioned is the butterfly spread. So with the butterfly spread, the benefits of using the butterfly spread, there are many, but first you can structure the trade for very defined risk, great for hedging. I like to use these for target directional trades or swing trades. They're great for directional, non-directional kind of pinning trades where we're looking for a certain strike maybe to go out and have expiration at. The other thing they're really useful for when you're trading a volatile high price stock like an Amazon or Tesla. Also really great for trading high volatility markets, when the volatility is a lot higher, so potential for big price moves. This can really help you to keep your risk super defined and low. These trade durations can be structured for 1 day to 2 weeks. They give you a positive theta, so you have no time decay, and the returns of any of the different option spreads that you can do are probably the highest on using a butterfly, so you can get 2 to 1, 10 to 1, or even higher. So those are some great benefits. So let's take a look at the QQQ trade we did for a market topping trade, and I showed you the put calendar on that last night, and then we also did a trade setup using the butterfly, basically the same timing and everything, and I'll show you the difference on that. So let me shift here gears and show you that trade. So kind of a review of the trade setup. What we did was this is a 3 ATR kind of an extension band that I like to use. So when price gets really extended away from the moving average that we use, typically a 20-21 period moving average, that is an area that you need to start being cautious. You might get what we call buying exhaustion, where the buying just kind of dries up. And then the other combination to this indicator is a reversal indicator here. So this is a 14 period moving average of that reversal indicator when it's overbought, above 90 percentile overbought. So when that crosses, we get a big extension hitting into that 3 ATR. That's usually a really good signal for a reversal, which would be just kind of a potential reversion to the mean. So we set up the put calendar on this date, the 15th. That was a Thursday, and then it was trading at 360 as well. And so the butterfly was also done at 360, and then traded down on the 19th, which was Monday, to 354.88. So let me show you that trade and the difference. Now the butterfly is going to have very defined lower risk, but you've got to really kind of thread the needle more so. But if you get the target right, they're going to give you a fantastic return on very, very little capital at risk. So the setup was doing a put butterfly, and again, this was for a 19 July expiration, which was going to be, that would have been Monday, this past Monday. Now it was traded at 360 when it was set up on actually the 15th. So this should be the 15th, not the 19th. It was taken off on the 19th. So it was set up on the 15th, and it was trading at 360. The max risk then was $79. So we bought the 360 put, sold the 355 put, and then sold the 355, bought the 350 put. So it's a 1x2x1 put butterfly, $5 wide spread. So the total cost was 79 cents debit cost, which would be $79 per one spread. So if you did one butterfly spread, your maximum risk is $79, and the maximum potential theoretical profit is the difference between your 500 spread width minus 79. So potentially you can make $421 per spread, and that would be a 533% return on your capital at risk. Now let's take a look here. When it went out on the 19th, it was trading down much lower, and let's take a look at what it was doing at that point in time. So on the 15th, the QQQ was trading at 360. Spread entry was at $79 per spread. Down here, 79 cents, $79 per spread. And then on Monday, the 19th, the market hit down hard and was trading at $354.88. And at that point in time, the spread was at $467. So it went from 79 cents or $79 to $4.67 or $467 per spread. So that is your profit of $389 per butterfly spread, and that's a 491% return over 4 days. Now, from that period of the 15th, when the market was trading at 360, into the 19th, when it was trading at 354, QQQ was down 1.42%, and the butterfly, though, was up 491% profit. So the advantage was, big advantage, time decay, volatility collapse, and a high return on capital at risk. So if you'd like to learn more about these types of strategies, make sure to join us at PowerCycleTrading.com. Good luck trading.